Good day, everyone. We will be starting shortly. We will just wait a few seconds for people to join. Please stay with us. Good morning, ladies and gentlemen. Today I will be your moderator. My name is Shayma Hassan, a Senior Proposition Manager at Refinitiv, an LSAG business, London Stock Exchange Group. And today we will talk about OPEC's role in price stability and the ensuing supply and demand dynamics. As we continue to see oil prices rise globally, we take a look beyond the COVID pandemic and examine how the Middle East production and exports are being impacted due to the OPEC decisions. In our agenda for today, we have many topics going from focused markets such as Dubai and Oman, on their oil benchmarks, a wider region of the Middle East to see what is the latest development in the crude market. We will also see what is the expectations and what is going to happen as oil prices going up and how the producers are taking advantage of that. And then we will see the prediction on how the market will be after COVID-19. So I would like to welcome our valued speakers. We have Mr. Ranjit Raja, the Head of Oil and Shipping Research of MIA at Refinitiv. And we have also Daniel Colliver, a Market Engagement Manager of Middle East at S&P Global Platt. And today we will be having their insights and views on what's happening in the crude oil market. So before we start, we would like to give some housekeeping rules. If you have any questions or any queries, please submit them via the Q&A box, and we will answer these at the end of the webinar. Please use the toolbar at the bottom of the webinar screen to access the resources such as speaker biographies, webinar material, technical support, and a survey to capture your thoughts and views on the discussion. So with that, ladies and gentlemen, I would like to welcome Mr. Daniel Colliver to share with us his thoughts and views on the market.
Thank you very much for the introduction, Shaima, and good morning, ladies and gentlemen. Thank you for joining me today. We're going to be looking a little bit about the oil price, but also the dynamics that have been moving the oil price. And just a quick look back, we can see what happened last year and really the roller coaster in the crude oil market that led to oil prices by literally a year ago falling to their lowest point for around 2 decades, when Platt's Dubai assessments fell to $13.55. Now we then saw a subsequent rise in the oil price, which has now been hovering around $60 in recent months. And a lot of that is linked to the OPEC Plus alliance and the subsequent reaction by the market of the reduction in oil available to it. Ranjit will be going into some detail around OPEC's move, so I won't be going into that in detail, but what we can see, as mentioned, is really that OPEC Plus output and how it's impacted the market. But when we look back and we see what happened before the OPEC Plus agreement was made, we can see that recent years, around 2018, 2019, the market was relatively steady, moving around a little bit of backwardation, a little bit of contango, as supply and demand dynamics move month in, month out. What we can see last April was that radical change and that complete collapse in the market. And that really led to, as that demand destruction happened, we can see that the supply for a certain period was completely out of sync with the demand that was available. And that led to an extreme, what is essentially called a super contango. And we can see that the Dubai spread, so the difference in price between the M1 and the M2 moved to an $8.51 discount, which is an extreme amount of contango. It incentivized storage. Ultimately, refineries were not looking to buy those barrels. They had to go somewhere. They went anywhere they could that was storage, including on vessels and all landed storage as well. We then saw, since that OPEC agreement being made, the market moving back into a certain amount of backwardation as the rebalancing took place. We can also see that the Brent-Dubai exchange of futures for swaps, the difference between the Brent benchmark and Dubai benchmarks, move into negative territory. And part of that is linked to a disconnect between the Eastern and the Western oil markets, but also linked to the fact that the Brent market represents Brent futures for loading 2 months in the future, whereas the Dubai swap represents oil that will be traded 2 months in advance, which actually represents oil loading even further forward. So that super contango then coincided with that Brent-Dubai EFS widening significantly, leading to the Dubai benchmark being in an extreme premium to Brent. Typically, of course, the Brent benchmark is at a premium to Dubai. Dubai is the medium heavy sour crude, Brent is a light sweet crude, and typically Brent is at a premium to Dubai. But we saw that move into a discount due to the timing and also that disconnect between the two markets. And we can see that then the EFS has rebounded in recent months, moving to almost a year high in February, and it's moved even wider in recent weeks. Part of that is linked to increased amounts of Iranian oil coming onto the market, putting pressure on other Middle Eastern sour crude barrels, which is then widening that spread between light sweet crude and medium heavy sour crude in Asia, and essentially consumed in Asia and produced in the Middle East. So as well as those significant changes that we saw in the market structure, we've also seen in recent years a narrowing of the medium heavy and the light sweet crude barrel. And a lot of that is linked to that complete demand destruction. Of course, it's not just demand destruction for crude oil, but it's of course demand destruction for the products that the crude oil produces. Last year, demand destruction was so extreme that we saw jet fuel cracks. That's the difference between crude oil and jet fuel turn negative. So actually, refiners, when they produce jet fuel, were losing money on that part of the barrel, which is essentially unheard of because the demand destruction was so great. That then in turn led to more jet fuel being blended into the gas oil and the naphtha pools, or being essentially cut into the naphtha pool by refiners, essentially to try and reduce their amount of jet production, which then in turn also weighed on naphtha cracks and on gas oil cracks. Significantly, fuel oil, which the market had expected to be under pressure through last year as the IMO 2020 rule came in, which cut the amount of sulfur content that ship owners could burn in their vessels without scrubbers from 3.5% to 0.5%, fuel oil actually performed relatively well. And that is because of the lower run rates and the increased use of fuel oil in direct burn by producers in the Middle East as they reduce their production of crude oil. Now, all of that has led to that Murban to Upper Zakum spot price, which is essentially within the Middle East, the spread between light, sweeter Murban and medium heavy Upper Zakum narrowing significantly. Historically, Murban commanded around a $2 to $3 barrel premium to Upper Zakum, and that premium eroded as refiners sought those medium heavy sour barrels and looked away from seeking light sweet barrels because they didn't want that light end part of the barrel. So that's been a significant change that we've seen in recent months. Now, when it comes to crude sourcing around Asia, the top four, the big four in Asian importers are China, India, Japan, and South Korea, and each have their own dynamics. China's crude imports have been healthy. They've actually shown a year-on-year increase despite the COVID-19 pandemic, and they are relatively diversified in their crude imports. While around half of that comes from the Middle East, they also seek a fair amount from Russia, particularly the ESPO grade, African crude, particularly from Angola, Latin American, North American, and then some other grades from Asia and Europe. Japan, on the other hand, is the least diversified, taking over 90% of its crude oil from the Middle East. India has looked to diversify in recent years, taking more Nigerian barrels and also Latin American barrels, also some North American barrels as well. But the majority of India's crude, of course, it's relatively short haul, comes from the Middle East, particularly favoring Iraqi barrels. South Korea has made the biggest strides to diversify their crude sources. They had been buying more European crudes due to the free trade agreements. But then what we can see is that in recent years, North American imports actually rose as trade tensions between China and the US escalated. South Korea was there to buy those barrels. And ultimately, all these barrels need to price. And the leading pricing benchmark for the Middle East for crudes that go to Asia is Platt's Dubai. And Platt's Dubai is reflecting a medium-heavy, high-sulfur crude oil for spot loading the Middle East 2, 3, and 4 months forward. And it is an alternative delivery mechanism. So while Dubai is the brand name, essentially, Platt's Dubai is the brand name for the benchmark, within it contains the alternative delivery mechanism, which means that sellers can nominate Dubai crude, but also Oman crude, Upper Zakum crude, Al Shaheen crude, and Murban crude in the seller's option. And that's using a partials mechanism. So if a seller sells 20 parcels in the same calendar month to a buyer, that converges into one physical cargo of 500,000 barrels, the standard parcel size in the Middle East. And then the seller declares the cargo of one of those 5 grades. Now, the alternative delivery mechanism ensures that there is adequate crude for delivery on any given day. And we can see over 3.5 million barrels a day of deliverable crude into the Platt's Dubai benchmark. Now, there's been an evolution in the benchmark, the addition first of Oman as Dubai production declined, and then the addition of Upper Zakum crude as well. And then in 2016, we added Al Shaheen from Qatar and Murban from Abu Dhabi. Murban crude historically had destination restrictions on the ADNOC part of the barrel, which was the ADNOC equity of around 60% of production. Now, what we'll look at later is really the changes that have been going on in Abu Dhabi and the way that they are selling and pricing their crude oil. But in addition, they've removed the destination restrictions for their crude oil. And that means that all those barrels can now be freely traded in the market. Platts only reflects freely traded barrels in our market on close assessment process, essentially barrels that have no destination restriction. And that means that all those barrels can now be delivered on a given day. So that shows that depth of liquidity that is available each and every day. And when we look at the sour crude partials participation, that has evolved in recent years. What we have seen in the last decade is the exiting of the market by a number of Western banks who they have essentially sold off or closed their commodity trading arms. So we do not see anymore the likes of Fibro, Morgan Stanley, Merrill Lynch, RBS Sempra. We haven't seen Arcadia or JP Morgan active in the market. But what we have seen in recent years is the rise of Asian consumers participating in the market on close process. And that's natural that Asian consumers of these barrels would want to have a say in the price. So we see the likes of Unipec, Hengli, Hengyi, PetroChina from China participating. We see Reliance from India participating. We also see trading houses from across the world and oil majors. And we see a real cross-section of the market participating each and every day. Now, in addition to the physical delivery, the physical mechanism that people buy and sell oil, people also, of course, look for risk management. And Platt's Dubai, the derivatives, so essentially the contracts that settle against the calendar month average of Platt's Dubai assessments, which are used for risk management, are listed on a number of exchanges, including DME Dubai Futures, NYMEX Dubai Futures, Tocom Dubai Futures, which are Japanese futures. They are yen denominated, and they settle against Dubai. And then ICE Dubai Futures, which is the most liquid. We've seen record activity last year coinciding with that extreme volatility. Now, all in all, over 10 billion barrels of Dubai derivatives traded last year, and that's around 30,000 lots each day, and each lot is around 1,000 barrels. So there is deep liquidity in the Middle East crude derivatives for Platt's Dubai, across a range of different venues. So I've been talking about what happened last year, and I think this year there are a number of things that people have been looking forward to and have seen changes. Of course, the world is constantly changing. We've seen the lifting of the Qatar embargo. We've also seen Iraq SOMA now exporting Basra medium crude. So there are now 3 crude grades exported from the southern terminals in Iraq. That's Basra light, Basra medium, and Basra heavy crude. Murban futures were launched just around a month ago, which I'll look into in more depth. The OPEC alliance, I'm not going to talk any more about that. That's Randith's part. There's questions around the Iranian sanctions and whether Asian demand will recover. Now, looking at the Murban futures, what we have seen in recent years are some changes by Middle Eastern crude oil producers in the pricing of their crude. So as mentioned, Platt's Dubai is that leading benchmark for crude oil sales from the Middle East to Asia, used by a range of different producers in the Middle East to price their barrels. What we've seen just last month is that ADNOC is now using IFAD Murban to price their crude. That is to price Murban crude oil directly, and then to price their other grades using a differential to Murban crude oil. So the Murban crude oil futures, which launched on March the 29th, 2021, reflect FOB Fujairah Murban volumes to be lifted by market participants. Murban loads from Jebel Dana and Fujairah, and ICE Murban futures represent barrels loading in Fujairah. As mentioned, that Murban official selling price will now be the month average of the market price. That's a minute marker for Murban at 4:30 Singapore time. And the other crude, ADNOC crude grades, so Bumlulu, Upper Zakum, and Das Blend, will be linked to the Murban futures contract. And those differentials are expected to be launched around 5 days into M-1, so the month before loading. So essentially, around the 5th of May, we would expect the differentials for June. ICE have announced a number of external supporters and partners in the new contract. And in addition, probably one of the most radical moves was that lifting of the destination restrictions, significantly not just for Murban, which is, of course, traded on the exchange, but also for the other grades as well. And that is starting from the first traded contract month of ICE Murban futures, which is June 2021. Also bringing a level of transparency to the market that was previously not seen in Abu Dhabi is that ADNOC onshore has started publishing a Murban crude export availability forecast report, which is essentially to say that each month what we can see is around 1 million barrels a day of crude oil will be exported from Jebel Dana or Fujairah, those 2 terminals where Murban loads. So giving some stability to the market in knowing, in surety, in knowing how much crude will be exported. Now, Murban production is around 1.5 to 1.7 million barrels a day. Part of that production goes into the Ruwais refinery. The production capacity right now is around 2 million barrels a day. And ADNOC is looking to raise that capacity target in line with their attempts to raise their overall crude oil production capacity to around 5 million barrels a day by 2030. So this is covering what we've seen so far. And if you have more questions that maybe I haven't answered, hopefully some more of those will be answered in the FAQ, which was recently updated in February of this year. You can click here. It's a PDF that has a number of those FAQs. And if you have any other questions, please do feel free to let me know. Now, one other thing that I'd like to just give a little plug to is the Platt periodic table of oil. This is now in its 3rd iteration. If you click on the link, it's an interactive periodic table. It covers around 150 different crude grades. It has their qualities, it has sulfur content, their API gravity, but it also now has the benchmarks that they are associated with, the producing regions, the quality, and the refineries that seek them as well. So it's quite a interesting and hopefully fun thing that you can use just to have a deep dive into the different crudes. Of course, there's hundreds of different crudes in the world, and this is something that continues to evolve. So that's it from me today. I will now pass over to Raja, who is going to be speaking about the role of OPEC in price stability and ensuring supply-demand dynamics. Thank you very much.
Hello, everyone. Thanks a lot, Daniel. That was really good. And so for the second half of the presentation, more from my side, we are going to be taking a look more into the OPEC's role in terms of their overall supply perspective, in terms of what has been made available to the market, what has been the ongoing and expected kind of changes that we are expecting from them, and also a little bit of look from the demand perspective in terms of the major demand centers and how the whole balance has been maintained over the past 2 to 3 years during the course of the whole COVID pandemic as well. So just to get started, a quick recap. Daniel had already covered in terms of the price perspective of what exactly was happening in the market due to the various agreements that has been put in place. But just a quick recap in terms of the agreements itself, or the various decisions that were taken during the different course over the year, has been that the current phase is what was essentially called phase 3 of the production cut agreement, which was decided last April. And technically, this phase was supposed to be going out or starting from the Jan of 2021 and going all the way to April 2022, where the production cut was supposed to be reduced to about 5.8 million barrels per day. But what has happened during the course of the year, as we know or as we have seen, is also that there has been various extensions and there has been various iterations that has been made, keeping in mind the evolving dynamics of the pandemic and also the various corrections and the various decisions that had to be kept in mind before increasing supply, keeping in mind how the demand has been planning out. And of course, yeah, we do know there was a major 10 million barrel per day that was cut, and for a demand destruction which was expected at that point in time of about 30 million barrels per day. But this production cut agreement has been one of the most successful in terms of the OPEC history, where the compliance, according to the last OPEC survey, was roughly at about 124%. And thanks to, of course, Saudi Arabia's additional and voluntary cuts they had put in place starting earlier this year, the compliance has been consistently above 100%, which has significantly helped in keeping a check on the supply that's been made available to the market, as well as the price recovery that we have seen in the last 1 year. In terms of the OPEC production numbers itself, a quick overview in terms of what we have seen over the past 1 year. So as we know, April 2020 was the period where their taps were left open and the huge dispute between Saudi and Russia went all in, and we saw Saudi producing a record volume of almost 11.7 million barrels per day. But what has been good is that since the agreement has been put in place, volumes have been curtailed significantly. Saudi has consistently maintained their production levels below 9 million barrels per day, especially for the last about 6 months or so. And the June 2020, when the production agreement came into force and all the countries were expected to start complying at their maximum accord, saw one of the lowest volumes in terms of the OPEC production levels at 22.3 million barrels per day. And as I mentioned earlier, the OPEC compliance has been significantly higher, about 100% because of Saudi, and also the compliance rate that has been maintained at about 124%. What has been interesting is also that the Libyan output, specifically during the last period, at the time when the OPEC agreement was put in place, Libya was going through their own internal crisis and hence were exempted from having any kind of a production cut deal or an agreement that has to be enforced from Libya's perspective. So after the whole force majeure that was lifted and Libyan production coming back into the market, they have added their outputs significantly, and they reached about 1.3 million barrels per day last month, which has been the highest on record for the past 8 years. And this month, we have started seeing, again, a little bit of budgetary and financing issues that has come into play, which has resulted in their output dropping roughly by about 300,000 barrels per day. So a quick snapshot in terms of how the overall production volumes is kind of shaping up. So we do know last April, when the production agreement, or May, when the production agreement started coming into place, the overall global crude production levels dropped to only just about 70 million barrels per day, which is which was at that point the lowest since November 2003. And of course, it has recovered since then by almost 6 million barrels per day by the end of last year. But what is important here is also to see how the overall share or the market share of each of the major producers globally has panned out during the phase as well. So starting from the initial production cut agreement, if we see Saudi Arabia to start with has kind of maintained their share roughly between the 12 to 13% range. So irrespective and depending on what's the overall volume that has been made available to the global markets, the contribution of Saudi Arabia has always remained consistent between 12 and 13%, which kind of says a lot in terms of their capability to increase and reduce the supply as and when needed. And we also saw the impact that they could create or the shock that they could create if and when there are no restrictions that has been put in place, which we saw last April, where the market share jumped from almost 12% to 14% in just 1 month. So what is important here or interesting here is also to see the evolution of the US crude market. So US roughly had about less than 11% market share back in 2016, but over the period of last about 4 or 5 years, their market share has increased significantly to almost 15%. And this has a lot to do with the volumes that were taken out of the market from the OPEC's overall group, and also the increase in the crude production levels from the US, which was able to kind of compensate and grab a significant portion of the market share from the major demand centers as well. And what we have seen from the OPEC's overall share, is excluding Saudi, of course, is that their market share has dropped by almost 7% in the last 3 to 4 years, where they used to have a big chunk of almost 27, 28% of the market share, which has now dropped to just about 21%. So trying to take a little bit of a look into the US shale itself, like we did know that US does play a huge share or a huge role in terms of the supply at this point in time, as of today's day and time. But what has changed is that the relationship or the correlation between the rig count and the production levels are no longer the actual measure or the kind of reliable measure to go on in terms of determining the capability of US in terms of their production levels. So this has quite a few things to be considered, mainly because the well productivity in the US has increased significantly. And we saw that in the recent last year's drop, where the overall rig count dropped by almost 75% in terms of the number of active rigs that were kept in place. But when we actually look at just the production levels in terms of the volumes, they dropped just by about 25%. So there is no longer a significant or the realistic metric to follow in terms of determining the capability of crude supply from the US markets. But it is nevertheless an indication to show that the US has kind of increased their operational capability significantly so that they are still able to do more with less. And in terms of their overall exports in the market, we have seen from the US in exports level, they have kind of maintained relatively steady, at least for the last 2 to 3 years. And that also means that not only are they able to kind of maintain their exports to the major demand centers, but they've also been able to tap into the huge inventory reserves at times where the production levels are kind of dropping or falling in order to sustain those levels that are committed to their consumers or the customers. And of course, we look a little bit more into deeper in terms of China as a major demand center, but irrespective of the volatility that they experience with China, with the whole trade deal that's going on, they're still able to find alternate markets in order to push their crude and find a destination or a home for the volumes that they're producing from their side. So in terms of the Chinese intake from the US, so what is interesting here is to see how US crude has evolved over the last 4 years, starting from 2018, where volumes to China averaged just about 190,000 barrels per day. And in 2019, it dropped significantly lower to about 113,000 barrels per day, primarily due to the trade war that was ensuing at that point in time, and they were not able to reach a significant kind of an agreement that had to be put in place. But the good thing is that despite the trade deal or the trade dispute that was going on, US was still able to push their volumes more into the Asian markets such as India, Korea, and also a little bit into the European side of things. But in 2020, once the trade deal was put in place and almost $25.3 billion of energy product purchases were agreed, we could see how the volumes to China started spiking back again. It almost tripled in 2020, where we saw volumes increasing to almost about 415,000 barrels per day. In 2021, there is still some overflow or some flow through of the volumes that have been agreed from 2020, and the trade deal is still in place, which essentially means as of for the first quarter, we have seen about 330,000 barrels per day come in from the US into China, but that is also expected to either sustain or slightly increase in the coming days as we see the kind of days go by and how the supply transpires from the OPEC group as well. Looking into the exports perspective from OPEC, again, a quick snapshot in terms of how volumes have been maintained or sustained from the exports perspective. Saudi again kind of stands out in terms of their capability to increase. Last April, again when the taps are open, they pumped up about 9.6 or rather put 9.6 million barrels per day into the market. But ever since, their exports have averaged just about the 6 million barrel per day mark. Especially since early this year, for the last 2 to 3 months, they've averaged just about 5.5 million barrels per day when the additional voluntary cuts came into play. And it is also important that since we saw about how US is trying to push its volumes to China, the Asian market still remains the primary focus for OPEC as a group. And that's also because almost 75% of all OPEC exports end up in one of the North Asian ports, which is primarily China, Japan, Korea, and Taiwan. And the Asian market still kind of remains the dynamic which kind of swings the importance that the OPEC group needs to put into place or take into consideration when they are establishing their contracted volumes, when they're setting their OSPs, and any decision that they take from their side. The Asian market kind of remains the primary perspective with which the decision is being taken at this point in time. And looking at it from the Americas perspective, of course, the Venezuelan exports has kind of dwindled, and they were averaging at about 800,000 barrels per day at the end of 2019. And it has dropped to just about 70,000 barrels per day as of March, and which is, as of today, the lowest on record that we have. And Libyan exports, again, they were suffering significantly at about 50,000 barrels per day towards July, August last year. And ever since the force majeure has been lifted and all the ports have been open for letting their oils flow through, we have seen volume surge from the country, and it crossed the million barrel per day mark. And for the last couple of months, they have, in fact, exceeded the million barrel per day threshold that they had set for the exports from the country as well. This month, for April, there was a report of a force majeure that was announced on the 19th of April from the port of Farega. This has, however, been settled, and it has been lifted on the 26th, which we are expecting to see a little bit of an impact in terms of the exports. But considering the volumes have been consistently increasing for about 5 to 6 months now, the ensuing or the new reports that are coming up, especially in terms of the force majeures, primarily due to the political basis, the financial issues, or the kind of the budgetary constraints that the country is facing between the NOC and the Libyan government, that's kind of starting to create more pressure in terms of how much they will be able to sustain in the longer term in the coming months or so. So if we look at, same the OPEC exports, but more from a destination perspective, like we mentioned, almost 75% of the volumes goes to North Asia. But if we split Asia between the top 4, which is basically China, Japan, India, and South Korea, these are the big 4 in the Asian markets in terms of the overall consumption that goes into these countries. If we look at it over the period of years 2019, 2020, and 2021, at least for the first quarter of it, the volumes from OPEC accounts for almost 60% of the volumes just between these 4 countries alone. And for 2019, they were averaging at about 57%. In 2020, like Daniel mentioned, China was one of the very few countries where they actually increased the intake for the year. And we could see that here for 2020, how the OPEC volumes have increased from to almost 60%. And 2021 has actually been even higher, with about 61% going towards the Asian top 4 as what we have seen for the first quarter. Of course, after this follows the other markets, which is the rest of Asia and the Mediterranean, the North African markets, the North American market, and also the UK and the Northwest European market. So the rest of Asia still contributes for about 14 to 15%. There has been a slight drop for this year compared to last year, but that's also to do with the overall volume that has been made available to the market. So if you see for 2021 till date, the Asia top four volumes has dropped to about 10.8 million barrels per day, whereas for the previous years, it was averaging roughly at about 12 million barrels per day. And similarly, for the Mediterranean, the North African markets, that has significantly dropped about 2.2 million barrels per day compared to the previous volumes of about 2.5 to 3 million barrels per day. So this chart is more to kind of take the major consumers, especially China, and then I will do maybe India next after this. So to kind of give a perspective of how the overall intake into China and especially the major players that are contributing for the Chinese volumes have been kind of playing out for the last 2 to 3 years. So if you look at the overall intake into China for 2019, it averaged about 9 million barrels per day, and 2020 that increased to 9.8, which is an increase of almost 800,000 barrels per day. And what has happened for the first quarter of 2021, it has gone up to 9.9, but what is more interesting here is the table on the right, where it shows how each of the countries have changed their position. Saudi continues to remain the top supplier, basically Saudi and Iraq continues to be the top supplier. But what we've also seen is the displacement of the other producers in the ranking or the volumes that they have been able to make it available for the Chinese markets. So Oman has kind of come forward in 2020 and 2021, but if you also see, there have been various reports floated between Oman and Malaysia put together. These are mostly the offshore barrels, which are not actually the origin or rather the native origin belonging to Oman and Malaysia, but various offshore barrels that has been transshipped off the shore of Oman and off the coast of Malaysia, which has eventually ended up in China. So similarly, Brazil has also been consistently been one of the top suppliers, but we have seen how that has started going down for at least this year in 2021. They did increase in 2020, but the volumes for the first quarter of 2021 has been going down. And like what I mentioned earlier, during the US and China relationship, we saw US starting to make a huge play into the Chinese market. And that is also coming, we can see here how they have started coming into the top 10 suppliers for China. And their volumes have been consistent for 2020 and for the first quarter of 2021. So that shows the dynamics in which the major suppliers are changing and how the traditional suppliers who are supposed to be catering or kind of expected to have the major stronghold for the Chinese market are no longer the major suppliers for China in the last couple of years. Similarly, for India, if we have a quick look, the overall input for 2019 was about 4.2 million barrels per day. For 2020, that dropped to about 3.9 million barrels per day. And for 2021, for the first quarter, we have again started seeing a little bit of an increase to about 4.19 or 4.2 million barrels per day. So again, the table on the right kind of shows the ranking of the various suppliers. Although the overall ranking for the first three has remained kind of the same, Iraq, Saudi, followed by Saudi, and followed by the UAE, we can see the volume, how they have been kind of volatile between the last 3 years. And that's also partly for 2020 due to the major loss in demand or the reduction in the quantities that India was taking in for last year. But again, what is interesting is also that the diversification of crude that India has been pursuing for the last few months, and especially from the end of last year, mainly due to how they wanted to kind of get out of the OPEC reliance and looking for more diversified crude intake, and that's where we start seeing the likes of the US, the Russian volumes, the Mexican volumes, and also they have started increasing their volumes that they are bringing in from Brazil, which hopefully when we see at the end of 2021, when we refresh this chart, we could see maybe Brazil coming into one of the top suppliers for the country as well. So they have started going far and beyond than their traditional reliance on the Middle East exporters or the Middle East suppliers, specifically from the OPEC group. And they have shown that they are willing to kind of pay a premium in order to kind of ensure their supply, mainly for at least the countries which are able to promise and consistently supply them with the required volumes that they would expect from their traditional suppliers to speak of. So this has been an interesting change in terms of the dynamics that exist from the supply centers and from the demand centers. And when we refresh this again at the end of the year, we should see a completely different rankings in terms of the major suppliers that stand in the top 10 among the major guys. And finally, in terms of the split itself of the overall OPEC oil from supply region, so this is a split between OPEC members. So if we see here, of course, Middle East OPEC members still constitute for roughly 75 or slightly more than 75% of the overall volumes from the group. Their 2019 volumes were about 15.5 million barrels per day, and that dropped about 14.7 in 2020 and about 13.2 for the first quarter. The African members, the major increase for 2020 has primarily been on the back of Libya, which we've already discussed quite in detail. And compared to the pre-crisis levels that they have, they have been able to push their volumes covered to the pre-crisis levels, which has significantly increased their 2021 volumes to back to 24% compared to their contribution of just about 21% in 2020. And Venezuela, we already saw that earlier, how their volumes have been struggling in terms of both the production and the export numbers. And that has kind of reflected in terms of their overall contribution to the OPEC group as well. So back in at the start of 2020, they accounted for about 3% of the OPEC's volumes. And for 2021, their share has just dropped to less than 1% or just about 0.5% so far. In terms of the crude slate itself for China, this is again specifically for Chinese imports. This is more to look at how their overall API and sulfur content has been changing over the period, over the last few years. So the charts on the left basically gives the average API and sulfur from the respective regions, depending on the sourcing pattern of various countries. And on the right, if we see, that is the consolidated running average of the API and the sulfur that has been taken for the entire crude intake for China for that particular quarter. So what this kind of shows or clearly indicates is a clear shift in terms of both the API and sulfur content of the crude that the Chinese refiners are kind of favoring. And that's also to do with the huge surge of the Chinese depot refineries that have come in, which are kind of looking more for the higher sulfur content, more of the soft crude, and also more of the lighter crude that they would want to put into their feedstocks for their traditional refineries. In terms, quickly for the price points, Daniel has covered this a lot more in detail, so I won't spend too much time on this. In terms of both the time spreads and the EFS, there has been some increasing pressure that has come off, especially on the recent highs of the EFS that we have seen, which puts a lot of pressure on the West African and the North Sea grades. But whereas the time spreads have come off from the recent highs, mainly after the OPEC's announcement of the relaxing of the output cuts that has been put in place. Murban futures, again, it is something to watch out for. They did record their highest number of futures contract that was traded on the 20th of April. Still too early to determine the kind of liquidity that we could be seeing from the region, but provided it is being made available, that could give a significant alternative in order to kind of provide the hedging risk purposes and also to reduce the basis risk for the players in the market. A quick touch upon Iran, specifically because they have been in the talks recently, and to try and see what kind of an impact they could kind of create. And of course, the Iran nuclear deal negotiation has been kind of reinitiated with all the major powers, and they have also been kind of trying to push their volumes as soon as the administration in the US started changing or was in the transition towards earlier this year or towards the end of last year. And what we can see here is at their peak between the crude oil and the condensate volumes put together, they can they can bring anywhere between 2 to 2.5 million barrels per day into the market, and of which primarily China and India have been the major receivers, which almost 30% going to the Chinese market and about 25% going to the Indian markets. So we do know that there are a lot of volumes that are transshipped offshore, which the actual numbers range anywhere from 300,000 to 1 million barrels per day. So there is no clear indication of what the exact numbers are. But irrespective, we can expect at least another 1.5 million barrels that can be expected to put into the market if the kind of achieve or derive, or sorry, come to some kind of a conclusion or a decision in terms of bringing them back into the market. A quick snapshot in terms of the overall floating storage from the market. Again, like Daniel mentioned, we saw a super contango towards the April of last year when prices plummeted, and that was more than enough reason for the various market players to kind of take position in the market, and the floating storage was the go-to kind of option for putting their barrels out at sea on board the ships. And they could see a huge spike in terms of the VLCC floating storage volumes that we saw back in kind of June and July. That is when the volumes would have actually been delivered. And we saw the volumes picking up to about 160 million barrels at sometime around end of June, early July. And of course, since then, a lot of these volumes have been offloaded in one of the destinations, and the current floating storage volume stands at about 45 to 46 million barrels at this point in time. And of course, a lot of these floating storage volumes were mostly destined to the Chinese markets. And at the peak, when floating storage volumes were kept just between China and Singapore, or the volumes that were destined for the Asian markets accounted for roughly about 90 million barrels at the peak of the floating storage boom. And finally, to take a quick look in terms of the freight market or the freight rates, again, the spike that we see here in October 2019 was the US blacklisting of the COSCO units, which was more of like a quick reaction from the market without having a full understanding of what impact it has on the overall VLCC markets to speak of. But the surge that we saw towards mid-March or early April is, or rather for the whole of April, was the increased demand due to the floating storage industry that we just saw a slide back. So they did sustain their rates for a good month and a half before dropping it down. And once the volumes were offloaded, then more tonnage became available into the market, which kind of started having having a pressure in terms of the price or the recovery of prices in terms of the VLCC freights. And not to mention, once the OPEC decision was being made in terms of restricting or the production cuts, the amount of volume that were made available to the market also reduced, which also kind of put a restriction in terms of the overall demand for the VLCC market. And a combination of that and the available tonnage that's been made available is consistently keeping a lid in terms of the recovery for the VLCC freights that we are seeing as of today. So that's pretty much the end of my presentation for now. And I guess we can transition to the Q&A. And again, a small reminder for all our audience, if you have any questions, please submit them in the Q&A box, and we should be able to pick it up one by one.
Thank you, Ranjit. That was very excellent insight. And before we go to the Q&A session, I would like to remind you about the resources available to download. Here you can access all the material of our speakers that they referred in their presentations. So let's go for a few questions. So Danielle, one question for you. Will other Middle Eastern producer launch crude future exchanges?
Thank you. Really interesting question. So far we've now seen DME Oman has, of course, the Oman crude production on a futures exchange. Dubai production arguably isn't significant enough to see its own futures, so that prices against Oman crude futures. And Murban now essentially covers all of those Abu Dhabi grades. So in terms of what other producers, I think other producers will be looking closely. Historically, Saudi Arabia has been conservative in its crude sales, selling on a destination restricted basis, and also without allowing resale of its crude. So to launch a futures exchange would be a sea change in the way they sell their crude, but it may be something that they are looking closely at to see how Murban futures develops. These are things that it's still very early days, arguably, for Murban futures. So we'll wait and see how that develops and whether other producers in the region would want to follow as well and put their crude on a futures exchange. Thank you.
Excellent, thank you, Daniel. So another question we have to Ranjit about Qatar market. So do you think that Qatar showed economic resilience during the blockade?
Yes, hi Shama. Yes, that's actually very interesting because Qatar has been recently, at least this year, one of the major members to kind of come into the headlines. But what has been surprising is that the Qatar market has traditionally been very gas oriented in terms of their presence in terms of the global markets. Oil traditionally is not their peak focus in terms of both the government and in terms of the infrastructure that they are kind of putting in place. But purely going by the levels of exports that we have seen from their market, we can see that they are roughly being able to maintain their exports at about anywhere between 25 to 30 million barrels per day on a month. Sorry, 25 to 30 million barrels in a month. So that has usually not been much of a significant difference compared to about, say, 36, 37 prior to the whole embargo or the boycotting that we had seen. So overall, purely looking at it from an oil perspective, they have been extremely resilient and they have been able to still cater to their primary demand centers that they have like a niche for their volumes. But in terms of the gas markets, I don't think there has been any impact at all because they are increasing their spending. They are increasing in the new North Field expansions that they are doing, and also the new infrastructures that they are putting in place for enhancing their recovery and exports from the country.
Excellent, thank you. We have also another question coming from the audience. I think, Daniel, maybe you can take it. So based on the Platt's estimates on production runs for the UAE and Iraq for the next 3 to 5 years versus OPEC outlook figures, it looks like that one, if not both, will leave the OPEC bloc. What is the Platt's professional views on this outlook?
Thanks. Well, it wouldn't be a Platt's professional view, but it would certainly, I suppose, be my personal view, is that OPEC is resilient. We can see after April of last year how the OPEC Plus alliance came back together and to stabilize the market by having those production cuts. And I think ultimately the UAE and Iraq are both key members of OPEC, and I would imagine that there would be some negotiation or renegotiation probably of production rates allowed by both those countries rather than either of them leaving the OPEC bloc.
Okay, great. I think we have also a few minutes to ask another couple of questions. Maybe Ranjit, you can elaborate more on the Qatar market and to tell us what do you think about them accelerating the energy transition in the near future?
So for the energy transition as such, I mean, like I mentioned earlier, their focus is more towards the gas markets, more on the LNG side, on the natural gas side of things. But maybe one thing that will be interesting to kind of keep a note on is also the relationship between Iran, because the North Field is something which kind of comes as a shared resource, and they will have to be kind of careful in terms of how they engage in their negotiations and the contracts for developing the field, which is kind of like a shared resource. But in terms of purely the energy transition perspective, I think they are fully prepared, and especially with the easing of the restrictions now, we can start seeing more close relationships in terms of their condensate volumes that they're pushing through, in terms of their gas exports or the infrastructures that they can regionally provide that for the particular country. But what would be interesting to see is whether, from a Qatar's perspective, considering they have built a resilience over the last few years in order to sustain the isolation or to sustain the kind of the infrastructure that they had to put in place, it would be surprising to see them to make the transition immediately into any of the local regional facilities. So they have a good supply chain in place now. They have a good logistical equipment that has been put in place in order to kind of cater to their domestic needs at this point in time. So we don't expect them to come back to the pre-boycott levels, at least immediately. And considering taking into factor how they are able to engage in further negotiations of contracts or even establishing volumes or relationships with their immediate neighbors will kind of answer to how they kind of make the decisions on having local spending, local infrastructure, and even the transition that they would want to make from outside into the GCC.
Great. I think we will have one last question as we're running out of time. So, Daniel, what impact will the Murban future contract have on the liquidity of Plains of Dubai?
Thanks a lot. Well, Murban futures represent a lighter, sweeter crude than Platts Dubai in the general basket, which is a medium-heavy sour barrel. But of course, if you buy Murban futures and you take physical delivery, you could deliver a Murban cargo into Platts Dubai. And ultimately, we see it as complementary. Murban futures is a futures exchange, and Platts Dubai is that physical assessment of Middle East sour crude on a partials mechanism. So those two things are different in that respect. And of course, the market is welcome to choose how they would like to price their oil. Platts Dubai has been around for over 4 decades and has that range of different barrels available for delivery. Thank you.
Thank you, Daniel. I think we have a chance to answer one more question. So, Ranjit, one question to you. So how will the current COVID pandemic affect the Indian oil demand profile?
Thanks, Shema. Yeah, I mean, I think that is very, very important considering the current scenario that we are hearing and that we are seeing as of today. In terms of the oil perspective, or more of like an oil demand perspective, like we saw, India has been in the process of diversifying their intake from various sources. But what we also need to see is what is going to be their refinery run rates considering their domestic requirements in the coming few weeks or months. So from what we are seeing, there are added lockdowns that are coming through. There are added restrictions that are being put in place. So it's a combination of more travel restrictions and also the domestic demand restrictions that are being fitted in, which obviously means the internal or the domestic refinery runs are going to be curtailed or are going to be dropped or reduced in the coming weeks. And that would indeed kind of make a huge factor in the decision for taking into account the amount of oil that they need to bring in order for catering to these refineries. So like we just said, they are well diversified at this point in time. They have enough supply in terms of their inventory and in terms of the contracts that they have put in place. So it's not going to have a huge impact in terms of availability, but what is going to create a factor is how they're able to recover from this COVID pandemic, which is in turn going to indirectly govern how their domestic demand is going to be picking up and how their refinery runs are going to be kind of shaping up following that.
Thank you, Ranjit. I think you guys have given very insightful information for the audience. And with that, I would like to close the session. I would like to thank our attendees and also our speakers for their valuable contribution. And I would like also to thank our partners, S&P Platts, for having with us arranging this webinar. Please let us know if you have any questions in the future, and hope it was very useful. Thank you very much, everyone, and have a good day.
Thank you very much.
Thanks, everyone.